Hi everyone, and welcome to this video in which we'll discuss the different methods that you can invest money in the stock market. There's three main methods that are commonly used. Firstly, we have lump sum investing, we have dollar cost averaging, and then we have what is known as value averaging. So if we start with the most common method, which is lump sum, what is this? Well, it's where we save up a chunk of money and we invest it in the market all at one go. Now, if you look at the chart on the screen, you'll see that at the beginning of the investment period, we invest the full sum of money, and then we can see the impact that has on the investment value over time. Now, there are several benefits to this type of strategy. The first is its simplicity, because we're just investing the money in one go, and then there's no need for active management afterwards. But the real beneficiary of this strategy is that you are getting returns on your money as soon as possible. So you're taking advantage of compounding. But there are some drawbacks as well. So firstly, you have to come up with the funds to invest. Not everyone has a chunk of money lying around. But one of the real drawbacks of this is that you're subject to market timing. So when we talk about that, what we mean is bad luck timing, or investing in the market shortly before a large fall, which leads to early losses on your investment. Next, we have dollar cost averaging. This is relatively simple and quite common. It's where we invest a set amount of money every single month into the market. And as you can see on this chart, we're making monthly contributions. But if you look at the value of the investment compared to the lump sum method, you can see this is much less volatile. We're not seeing the big swings in the movement of our investment. And that's because we're putting money in at regular periods. So we're buying when the market is down, and we're also buying when the market is up. Some of the benefits of this is that it's relatively simple and it encourages regular saving and investment. But the main benefit is around that volatility. Because we're continuously putting money into our investment, we're not subject to those big swings in price movement. And that can be much more bearable for investors from a psychological point of view. However, with everything, there are drawbacks as well. So firstly, because you're only investing part of your money, you're not taking advantage of the full effects of compounding. So you have some missed opportunity costs there. As well, you need to be a little bit more active and quite committed to putting that money in every month. And because you are doing multiple transactions, you might have some higher transaction costs as well. Now, onto the final method. This is less known, and that's because it's more complex. It's known as value averaging. With this method, we determine a future value that we want our portfolio to be at set points. And as the value of our investment changes over time, we either add money to get it up to the level we want, or if it's above that, we withdraw money. Now, this is very similar to dollar cost averaging in that the main benefits are the significant reduced volatility in the portfolio. However, one benefit it does have over that dollar cost averaging is when the market is falling, you're not just contributing a set amount to it, you're contributing even larger amounts to it. So you end up with better market prices and potentially better returns. But there are some negatives to this as well. It is much more complex, you do need to be a lot more active, and you need to be able to do the calculations and monitoring your portfolio frequently. There's also the potential for higher transaction costs because you are adding and withdrawing money more often, and it can require more capital because if you do see a sharp drop in the value of investment, you have to top that up to the set value that you're targeting. Now, if we have a look at the difference of all of these methods together on this chart, what we're looking at is your return on investment. We can see that the clear winner here is lump sum. Now, the reason behind that is because we're taking advantage of compounding as soon as possible and getting returns on our full amount of capital. As you can see, it is much more volatile than the other two methods. So with dollar cost averaging and value averaging, we have less volatility in our returns, but overall, we're going to end up with a less amount at the end because we don't take full advantage of that compounding.